Jason, you are pretty down with all the new cryptocurrencies. You're always on top of it. Have you heard of this new one called Decibel?
No.
So I guess the whole idea behind Decibel is that the whole proof of work system is done by speaking through your mic. They're saying it's a really sound investment.
I think you're gonna crush it then.
You just got it.
That is the worst dad joke I've ever heard.
Okay. Jason, so okay, I'll dive in. So Jason, in the last week, there was an absolutely titanic explosion within the crypto space. That joke, by the way, is going to slay by the end. It's a full circle episode. But there was this implosion of a stable coin way out sort of in the far reaches of the cryptocurrency space. And it was this really interesting case study that I actually myself was involved in from an investment perspective, just dabbling in my own personal account. And I think it sort of speaks to what's going on in cryptocurrency in general. Thought it would make great content for this week's episode. Just start off with, what are stable coins and why do we even need them?
So the general idea of stable coins is it came out with the guy, you need something to trade against. So once you're in the crypto ecosystem, and let's say you're trading Bitcoin or Ethereum and you have gains to make, but you want to monetize those gains, you need something to transfer to. If you had to transfer all the way back out of the system to fiat, it would be a lot of fees, a lot of taxes, a lot of headaches, and a lot of time. So what they created was within the ecosystem is some form of stable coin. That way you could capture some of those gains, hold it in a cash-like instrument, wait for when you wanted to get back in, and trade back into the different cryptocurrencies you wanted. So it started out pretty simply with things that were backed by the dollar. So things like USDC, Tether, allegedly, these things are backed. Sorry, I couldn't help it.
Allegedly.
How does a fella get caught up in that sort of business?
Are backed one for one with US dollars. So it's the digital equivalent to having a US dollar. And that's what provides the stability, is the simulacrum to the dollar one for one.
So the basic idea here is we're on-ramping into the crypto space. And then because with a digital wallet, we actually can't hold a US dollar, we need some sort of token that everyone agrees represents a US dollar.
Exactly. And then that allows us to have a stable asset that then we can trade with and monetize our profits or dollar cost average back into our trades.
So like a really basic stable coin, I think this can be over-engineered, but the simple idea would be you want to launch Jason coin that's equal to $1. And to do that, basically, I come to you with $1 and you hold it in your reserves and you give me one Jason coin. And the fact that I can come back to you at any time with a Jason coin and redeem it for $1 means that that Jason coin is always worth $1. So that's how the peg in sort of the simplest model is maintained. It's because you are always fully collateralized with that dollar in your reserves.
It's basically how fiat started, right? It was fully collateralized by gold reserves that you could trade in your paper dollar for the equivalent of ounces of gold.
Now, what's interesting to me is that over time, there have been all sorts of different stable coins that have come out, right? So crypto, which is notoriously decentralized, didn't seem to like the idea of one centralized reserve being responsible for all the cryptocurrency that was out there. So for example, instead of me trusting you to maintain the reserves, and give me Jason coin. So the equivalent there might be like USDC, where Circle actually maintains all the reserves and they maintain the USDC token. I might say, well, why don't we actually create almost like a smart contract bank that allows me to deposit some form of collateral and get out a stable coin that's backed by that collateral, typically over collateralized. So DAI is an example there from MakerDAO. But that's not even the full limit. They've gone on to now from beyond fully collateralized and centralized to sort of these over collateralized, decentralized. There's now this new regime of stablecoin, which is partially collateralized, and algorithmic. Walk us through that.
So the idea, you're correct, with DAI being, let's call it 150% collateralized with other tokens, et cetera. And then they have a arbitrage mechanism, which they encourage, that allows the price to hopefully maintain its peg. But they also have that over collateralization because of the volatility in the crypto markets. So even if you had a massive run on the bank, you had a liquidity event that was over, seconds or minutes, hopefully that over collateralization will allow them to maintain that currency. And that was the point of having that over collateralization. They've been through multiple market sell-offs, and so far they've been doing just fine with DAI. So then people were like, well, maybe we could tune this up a little bit, and maybe we could have under collateralized currencies. And so now you'll have things come to the market like fracs that were maybe 70 to 80% in these stable coins like USDC, and then they would have 15 to 25% in their newly minted coin of what they were creating. So that way they felt they could balance that stability based on a dollar being 75% a stable coin, 25% in their newly minted coin. And over time they felt that the market would stabilize those. But as you know, we create what positive feedback loops with a mechanism like that, which, as we all know, positive feedback loops are actually quite negative. So what that can create is an amazing feedback loop that spikes the price, but in the same way, it can create a feedback loop that absolutely tanks the price.
So in the far-reaching corners of the MATIC network, people might know the Bitcoin blockchain. They might have heard of the Ethereum blockchain. What you have built on top of Ethereum is a whole nother layer called MATIC. And the idea behind MATIC is it's basically saying we're going to have this second level of transactions that can all occur much more quickly on MATIC, much more cheaply, and then we'll basically wrap those up and push them down to Ethereum. So it's still running on top of Ethereum, but it's a much faster and much younger network. And so they're trying to incentivize people to move their assets from Ethereum, bridge them over to MATIC. So MATIC itself is paying all sorts of rewards if you're willing to move your assets over and be a part of the liquidity provider ecosystem. And with that new layer came a new stablecoin. Enter Iron Finance. Now, Iron Finance actually is a fork of another fairly successful stablecoin project called Frax. They've been also running on Binance Chain. So people thought that they were pretty well established, but as it turned out, there were maybe some corner cases that were unfortunately overlooked.
And that's the problem, is at the end of the day, we risk smart contract bugs, or the logic is not fully thought out, and people figure out a way to corner the market that gets exposed over time.
So I think it's important to talk through how the actual arbitrage is supposed to work in theory. And so we'll walk through this slowly because it's a little bit complicated, but I think it's important. So there's really three tokens we need to be aware of. There is USDC, which is the stable coin that is centralized. It's provided by Circle. That is effectively the collateral to this whole system. So another stable coin is going to be used as the reserve at Iron Finance. Then there is the Iron coin. Iron is their stable coin. And finally, there's Titan. Back to my Titanic joke. Comes full circle. Titan is the governance token of this entire system. So how's the arbitrage work, right? Because the whole mechanism here is based on arbitrage. Well, let's say Iron, right? The stable coin is worth more than $1. Well, what can arbitragers do? They can go buy $1 of Titan and USDC, deposit it at Iron Finance, get an Iron token out, which by the way is worth more than $1, go sell it and earn that spread. And in selling that token, what they've effectively done is, because they're buying Titan and selling iron, they're driving the price of iron down, hopefully back to $1. Conversely, when iron is worth less than $1, what they can do is people can buy iron and then go to iron finance and redeem it for a mixture of USDC and Titan that's supposed to be equal to $1. And as people sell that, it drives the price of Titan down. But because they're buying iron, it's driving the price of iron back up to $1.
So Phil recruited me to sell these cards, and now I am recruiting you.
Who is this guy again?
Don't worry about Phil. He drives a Corvette. He is doing just fine. Okay. Calling cards are the wave of the future. These things sell themselves.
So it's this arbitrage-based relationship, effectively, that is trying to keep the iron peg equal to $1, despite the fact the reserve never really has the full dollar collateralized behind it. There is one key part of this, though, which is that the amount of Titan token that you get when you redeem your iron is not equal to the market price of Titan. It's going to be based on a 10-minute TWAP of the price. And that is really, really critical, because if the price of Titan starts to go below the TWAP, then the amount that you're actually getting out when you redeem that iron is now worth less than $1. And so if you stay below the peg for too long, you end up risking a permanent depeg. And that is effectively what happened.
That's why I said, ceteris paribus, all things being equal, demand dynamics work until you have a bug or a flaw that's exploitable in your smart contract code. And people found this bug and then fully exploited it, which led to what we colloquially call a run on the bank. So, you know, what did happen when people started exploiting it? The cascade effects, like we're saying with positive feedback loops, can be disastrous.
So when I started getting involved in this project, I think the Titan token was worth $4. It quickly ramped up to about $11 in 2 days, and then fell back down to $4. And I said, hey, this is the Wild West. This is what happens with the Titan token. Now, I was in a stablecoin liquidity pool. So I was providing, I think it was USDT, so Tether, to match iron. And I was earning Titan tokens to the tune of like 1% a day. So you put in $1,000, you were earning $10 a day just for providing liquidity.
It sounds like a get-rich-quick scheme.
Yes, thank you. You will get rich quick. We all will.
Taking all this extant risk we'll get to eventually. And over time, like within a week, that Titan token went from $4 all the way up to $60. And what seems to have triggered this cascade, it's hard to tell, but people the cool thing about the blockchain is you can go back and look at the transactions that happened. It seems like a couple big holders of Titan sold in a big way that drove the Titan token from 60 down to 50. Now, again, the important thing to remember here is that when you're redeeming iron at Iron Finance, you were getting an amount of USDC and Titan token that in conjunction were supposed to sum up to $1. But the amount of Titan token you were getting was based on a price that was on a 10-minute TWAP. So if you had a sudden sell-off, well, the TWAP price was much higher. So the amount of Titan you were actually getting wasn't sufficient enough to actually go out and be able to redeem a full dollar's worth. You were actually getting less than $1, which meant that if you were trying to perform this arbitrage, you actually couldn't buy $1 worth of iron anymore. You could not repeg iron token. So if you get a sell-off that then invites a panic, people go, ooh, I just went from $4 up to 60. I really want to lock in my gains here. And everyone starts selling. And the price never gets back above that 10-minute TWAP. It's unlikely that you're basically going to get to the repeg. And that's exactly what happened. And within 24 hours, the Titan token went from $60+ to actually zero. It went to zero. I think it broke to such a low level that no longer could floating point accuracy correctly price what the value was on our computers, and it went to zero, which actually had this other interesting smart contract bug. Because everything was always partially collateralized, at the end of the day, you could get out at least 75 cents of whatever iron you held. You always had that 75 cents in reserve. The problem was the smart contract was written to say, so long as the Titan token value was greater than zero, not greater than or equal, but greater than zero. So once the Titan token hit zero, nobody could redeem anything anymore, and all the money was stuck. And so the developers actually had to basically push a patch through, which took 24 hours before people could continue redeeming.
But wait, there's more. And this story gets better than better. So part of the stories too that we didn't hit on so far are then Mark Cuban was involved. So Mark Cuban wrote a great blog post saying that he was a liquidity provider in the Iron Finance system. And it's likely he did that because he's an investor in Polygon, the underlying layer 2 solution. So maybe he wants certain projects to do well, because then it would behoove Polygon and his investment in Polygon. And so I don't think there's anything nefarious there. He was just trying to, figure out the system like everybody else. So some people speculate that he was one of those whales that sold at $60 that instigated the cascade.
I found the Mark Cuban thing to be like particularly ironic, because he wrote the blog post a day before the entire system crashed. And then the day after, he started calling for regulation.
Circling back, I really wonder, we use this idea of a Ponzi scheme.
How is this not a pyramid scheme?
All right, let me explain it again.
Right, and is maybe, or Ponzi scheme now been calling it a rug pull. Is that the way to look at it? Or can we use like your traditional model of like a flows analysis, or looking at it from the other colloquial phrase of, if the product's free, you are the product. So nobody questions where these huge APR and APYs come from. And if they look for a second, it's coming for you. Like, who's going to be the last bag holder based on the inflows that people are chasing yield? Is that a fair way of looking at it?
I think there's a bag holder aspect to it if the project isn't successful, right? So the project is trying to incentivize people to use the project with these emissions. Imagine for a second that I create a new beverage. I create a new company, and it's called Corey Coffee. And I say, for every bag of coffee you buy, for the first 5 months, I'm also going to give you shares of the company. And you go, wow, this is a really great deal. Well, suddenly there's sort of that positive feedback loop. I get to show tons of people are buying my coffee, but are you really buying the coffee because you want the coffee, or are you buying the coffee because you want the shares? And by the way, at the same time, I'm posting more profit. You think your shares are going up in value. The question is, what happens when the emissions stop? When I stop giving everyone shares, was I able to generate enough true demand? Did I get the coffee in people's hands who go, you want to know what, even without the extra bonus, I still want to be part of this ecosystem? Those are the projects that are able to then step away from sort of the incentive structure and continue to be successful. And we have seen a number of those.
So you're in the Discord channel, it's melting down. What happened to your position?
Well, the bad news was I was not at my computer. I was out with my in-laws as this entire meltdown is happening. Lesson learned, you need to have your wallet on your phone as well. But I knew at the end of the day, at least in theory, the stable coins I had, I'd get at least 75 cents out, and maybe a little bit more depending on when I was able to redeem some of that Titan, how quickly I could sell it. I had been in the pool long enough, earning that 1% a day, that even after, if I took a full 25% haircut, that I couldn't sell any of the Titan and it was worthless, and I just got the 75 cents of USDC in reserve for every iron token I got back, that I was close to whole. So the good news was, at least for me, I had been, all the Titan tokens I had been earning over time, I sold every single day to held in USDC. I mostly walked away whole. The better news is that I was earning like 400% annualized, or maybe actually it was close to 500% APR on that project right before it crashed. The good thing is I have found a new project where I'm earning 1,000%.
Phil has recruited me and another guy. Now we are getting 3 people each. The more people that get involved, the more people who are investing, the more money we're all going to make. It's not a pyramid scheme. It's not even a scheme per se. It's
And then if we want to think about Carnetie's fairness, on the opposite side of that, do you think that the tech we're developing from this experiments will have some sort of actual economic dividends 5 to 10 years from now? And that's the entire point, is like, you have to kind of break a few eggs to make an omelet.
No, this is pure degenerate gambling. Well, Gary Basin, who joined us a couple of weeks ago, I think probably said it best. This is an ecosystem that has been developed that allows for real-time financial innovation. And with that, you're going to get scams. With that, you're going to get failed projects. You're going to get code bugs. And hopefully, that sort of rapid iteration that can happen in this system can actually push it towards a more robust, more stable, more innovative place than is really allowed with traditional regulated financial systems. It's just a question of when it's going to get there. So do I expect more stories of projects like Iron Finance that have great intentions and horrible outcomes? Absolutely. I think that's part of the evolution of this space. But I think when you think about the creativity that's being applied and the mental horsepower to trying to solve some of these problems in a very creative manner, it strikes me as a low probability outcome that nothing comes from this at the end of the day.
I have to go make a call.
Now make sure you like, subscribe, and hit that notification bell so you never miss one of these amazing episodes.